Hello, I'm David Mandy, president of O&M Partners in New York, and I want to welcome everyone today to the Osisko Mining Town Hall webinar. Osisko trades on the Toronto Stock Exchange under the symbol OSK, and they also have a OTC listing, OVNNF. For those that are new to these broadcasts, O&M has become the link between the investing public and public companies. In times past, these groups passed each other like ships in the night. Over the past 6 years, we've created a digital roadmap that enables us to keep pace with the tremendous changes in investor demographics and how they receive information. We want the broadcast to answer your questions. Questions can be easily answered by going to the question portal of GoToWebinar or by emailing us. For any questions that remain unanswered, we'll follow up in a timely manner after the call. For those of you who dialed in with your phone, the only way you can hear our pre-recorded introductory presentation is on your computer speakers. If that's not possible, you'll be able to hear the presentation after 10 minutes, so please stay tuned. Before we turn to our host, we have the pleasure to present our special speaker, Steve Rentschler, who's the president of Green Room Consultants. O&M has worked with Steve Rentschler since his days as a veteran institutional investor with two of the largest dedicated natural resource funds in New York. Steve met with resource companies of all sizes. He's seen every type of presentation, effective and not so effective. A few years ago, Steve started Green Room Consultants to advise the very companies he used to sit across from. He's a master of creating informative and strategic presentations that build investor confidence rather than confusion. Steve's currently working on launching a new information platform called ValueVest, where companies can highlight the positive social impacts they make and investors can easily find information they want. On that note, I'm going to turn the call over to Steve.
Hello, everybody. I'd like to share some thoughts this afternoon that I hope will be helpful to you in forming conclusions about the attractiveness of investing in the gold space now. I've targeted my remarks for those generalists in the audience who may be new to gold, so if you're an old hand, I'd ask for your indulgence now. Gold's both a timely and timeless subject, and you don't need to be a gold bug to generate investment returns from it. So gold's currently trading around $1,740 US an ounce and has attempted to break through the $1,800 mark a few times over the last few months, only to be thrown back. Is $1,800 the top, or is it only the end of the beginning of this newest price rise? Can gold prices break the all-time high of about $1,900 from September in 2011? If you invest in gold companies doing business around the world, the question might be easier to answer because you know that gold prices in other currencies are already making new highs on a frequent basis. Why isn't the same thing possible in US dollars? I suggest new highs certainly are possible, and here are a couple of reasons why I think so. One of the biggest knocks against owning physical gold has always been the argument that gold bears no interest and therefore represents a lost opportunity cost for the investor. This was the centerpiece of the argument used to convince central banks to sell or lend their gold reserves decades ago. Why own it, other than for use as an inflation hedge? The old saying is that an ounce of gold can always buy a good suit. Or why own it unless you're going to have the ultimate in a safe haven asset? You have no counterparty risk if you have the ounce of gold in your hand. With governments and companies selling 100-year bonds at low interest rates and negative interest rates included in almost every central bank's policy, I think the opportunity cost argument is pretty well weakened. Now, besides the absolute price level, is there some other way to tell if gold is expensive or cheap? Institutional clients always found this chart interesting. It shows the relative size of the U.S. monetary base compared to the value of U.S. Treasury's gold holdings. The U.S. remains the largest holder of gold at 261 million ounces. And yes, I'm giving an unseen wink and a nod to those who say, who really knows if it exists? You see that there are two spikes which represent times of gold overvaluation in 1938 and 1980. And following those spikes, financial assets outperformed while gold prices fell or remained constant. Remember that the gold price was fixed in price until 1971. And in 2000, at a point of radical undervaluation, the world central banks sold their gold holdings. In fact, the Swiss and British sold at almost the lows of around $250 an ounce. Look where we are today, with the ratio basically at its lowest point, which represents radical gold undervaluation and indicates gold price outperformance versus financial assets going forward. This is with gold already reaching for $1,800. And clearly the explosion in the size of the monetary base is helping the equation in the case for gold. But are there other indicators that point to a fall in overall demand from these high price levels? And traditionally, about 50% of global demand comes from jewelry. And there are many nuances such as seasonality and import taxation levels in India that would require much more time than I have here. All else being equal, high prices and a weak Indian monsoon season don't help global jewelry demand. But I'd like to focus on a few recent indicators that signal gold demand remains strong even at these price levels. The first indicator is the central bank gold demand, which has been tremendously strong. This is following many years when central bank selling was the norm. All central bank sales basically stopped by 2012, but some countries, such as China and Russia, have been increasing their gold purchases until very recently. Bank purchase records were being broken until COVID appeared, but a recent survey by the World Gold Council found that central banks overwhelmingly plan to continue to purchase more gold as they diversify away from US dollar holdings. We've also seen recent, very large increases in demand by investment funds. Gold ETF inflows have been rising rapidly, and should these inflows continue apace, the annualized numbers are staggering. They represent a tremendous percentage of global annual gold production. So where will all of this additional gold come from, and what gold price will it take to make it available to the ETFs? And okay, here's another silent wink and a nod to those with the doubts about whether the ETFs even actually have the gold. And as a final indicator of why I think gold prices are inevitable, there are supply issues to be dealt with. Gold production faces all the other headwinds that any other commodity faces, but to me the most important and the hardest concept for generalist investors to wrap their heads around is that of resource depletion. And I think I understand why, because in any other industry, the components needed to physically produce something are always assumed to be immediately or almost immediately available at some price. Therefore, stable production of iPhones or bicycles is assumed to always be possible, though perhaps with some lags associated with an increase in production. It's not quite the same with natural resource producers. For a given industry in a sector, such as gold, it's true that there's always a component of price sensitivity that will unlock more product. This is the concept of economic reserves, and why we'll never run out of any oil or any other commodity. But there's a catch to it. And that catch is that individual producers in the mining industries build and operate their mines according to detailed financial and production plans. And these plans are centered around the extraction of a defined amount of economic reserves for a given project. We know that maximizing the net present value of a project almost always includes getting the highest grade material through the mill first. And during periods of low prices, we also know that mines will high grade their resources in an effort to stay afloat. As a consequence, as mines get older, they almost always exhibit a decline in production, because they are often mining the lowest grade material out of what they once had. Now, if you stack up all these individual mine production profiles, you arrive at the cumulative industry decline rate. This built-in headwind must be overcome to simply keep annual production flat. The gold industry is no different than any of the other metals. New mines must be developed to replace the old. Around 2015, we calculated the gold industry was subject to about a 4% depletion rate. I doubt it's changed much since. To overcome that, you have a backdrop in which it's never been more difficult to develop new projects. Aging mines, permitting timelines, political risk, government interference, social license, and environmental concerns all hinder additional production. Just look at how the industry's changed in response to those challenges. As just two examples over the decades, the unchallenged leader in gold production, South Africa, has fallen tremendously as their old mines reached unbelievable depths and political instability increased, while China's emerged as the world's largest producer. I'd like to end this presentation with this last thought. This is the life cycle chart of a mining company, commonly referred to as the Lassonde curve. It honors Pierre Lassonde, the co-founder of Franco-Nevada, who used the chart to explain periods of relative strength and weakness in share prices as companies progress through the different development stages on their way to production. This is assuming that a company makes it all the way from the left to the right, because very, very few do, which is an important consideration for you as you invest. Because of all the headwinds the industry faces, I think the valuation peaks and valleys of this chart will compress, even if the timeline to production is actually expanding. As higher gold prices generate higher cash flows, gold producers will be looking to buy replacements for their reserves. Many of these larger companies slashed their exploration teams when gold prices were low, or simply acknowledged that exploration wasn't their strength. As M&A once again increases, along with the fear of missing out, in my opinion, transactions will take place at earlier and earlier stages on the curve, and probably at higher than historically seen valuation metrics. I think that gold prices have a lot farther to rise, and while you could make the argument for a doubling or tripling of prices, maybe we wouldn't be too happy with the shape of our global society if we got there. But gold prices don't have to double for gold stocks to do well. As investors, we understand the operational leverage that companies enjoy when the price of their product rises significantly. But if you're new to gold investing, you may not be aware of how high industry costs are, and that the opportunities to reduce costs are few and far between. That high cost base will magnify the positive effect of rising gold prices. If gold prices achieve only a significant portion of the gains many analysts now expect, the prices of all gold stocks, in my opinion, will be multiples of current levels. I think it's a great time to be investing in the space, and I encourage you to find out more about gold. Thank you for listening, and I'm certain you will enjoy the following presentation.
Thank you, Steve Rentschler. Really appreciated your comments. Now we'll turn to our host today, John Brzezinski. John is the president, the chief executive officer, and the director of Osisko. John's a registered geologist in the province of Quebec. He's a veteran in the mining industry with 25 years of experience, both international and mining and development projects. He began his career as most of the time spent in the field as a discovery geologist. John's a director of Osisko Gold Royalties since its inception in 2014. John was one of the original three founders of Osisko Exploration, Osisko Mining Corp. John was part of the award-winning team that founded, developed, and put into production and sold the old Osisko Mining company, which was a smashing success. It sold to Yamana and Agnico Eagle in 2014 for $3.9 billion. My observation in this business is that the people that do it once do it again and again. Success is repeated by the same management teams, and I really, no doubt, put John Brzezinski and his team right up there at the top of the list, and it's a real pleasure to turn the call over to John.
Thank you, David. And thank everybody for attending today's presentation. As David mentioned, there were three of us back in 2003 that formed the original Osisko Mining. I always like to stop on the cover slide here and point out that that's not a stock photo that you're looking at. Those gold bars were the last bars that we produced at Canadian Malartic before we handed over the keys to Agnico Eagle and Yamana in the summer of 2014. At that point, we'd produced about 1.2 million ounces of gold from Canadian Malartic. We weren't willing sellers. It was a forced sale. We were put in play by Goldcorp at the time. They launched a hostile bid of about $2.6 billion. We fought them off the best we could. But in Canada here, we don't have a just say no defense. What typically happens after a hostile bid is launched is about 30% of the stock ended up in the hands of the arbitrage players in New York. And so it was going to be a sale one way or the other. We did manage a better sale. As David mentioned, it was close to $4 billion. So literally over the history of the company, which was about 10 years from the first day we started till we sold the company, we raised about $1 billion over the course of the life of the company to explore and build Canadian Malartic, and we returned $3 billion to our shareholders, which is a pretty good record. Now, we formed the royalty company out of the sale of the original Osisko Mining Corporation in 2014, the next day after the sale. But what we did 1 year later was we realized that we'd start losing our key engineers and geologists unless we started a new mining company where they could go find new mines and develop new mines. So I took the reins of the new company. We amalgamated 5 companies in the start. We've done about 60 or 70 transactions since that point. We started as about an $8 million market cap company with $10 million of cash in the bank, and today we're just over $1 billion market cap. And as I'll show you here in this opening slide, we have fully diluted about $500 million of cash. We've advanced our principal project, Windfall, to world-class scale over the course of the last 4 years. We currently have over 5 million ounces with a grade of over 8 grams. It's actually 5.2 million ounces in inferred plus indicated categories at a current average grade of about 8.5 grams. We just completed a large financing, which brings our treasury to about $320 million of cash, plus some equity positions we own. We have a series of warrants and options outstanding and some other instruments such as cash back from the Quebec government. That should they all come in, it brings the total to $500 million. And what's interesting to note there and important to note is that it'll take us about another $150 million to complete the work to feasibility stage and get permitting at Windfall. We should have enough money left over to build the mine. So really what we did with the closing of that financing yesterday was we removed the financial overhang from the company, very much as we did with Canadian Malartic back in 2009. It was a similar situation when we went to finance Canadian Malartic. It was after a large financial crisis. Over the course of 2009, we raised $1.05 billion. Our share price at the time was about $4.50, but within about 6 to 9 months, our share price had gone up almost triple because the market realized that if they wanted to own our shares, they had to buy them off the market. So I think we're due for a similar re-rating here with the current Osisko Mining. We're trading today at about $3.25, $3.30. But I suspect that a lot of value is going to come into our share price now that the market is realizing that we aren't going to have to go back to finance again to build this mine. We have a singular focus, and that's the Windfall district. We own 2,700 square kilometers, which is the size of a whole district, equivalent to the famous Timmins camp in Canada or the Val-d'Or camp. We own about 70% of the land area in that area. Windfall, we believe, is the first of what could be many deposits, and we control the best part of the trend. So Windfall won't be the only part of the story that we have to tell this year, and in coming years, we suspect there'll be other deposits to follow. Our program this year is to complete 300,000 meters of drilling. 2/3 of that is going into resource conversion. We currently have 1.2 million ounces of indicated resource. We intend to get to about 2.5 to 3 million ounces of indicated by the end of this year or very early next year, which will allow us to use those numbers in the feasibility study, which will then lead to permitting and, all things being equal, construction and production by somewhere in 2023, second half. Besides the massive amount of drilling that we're doing this year, and there is no other company that's been drilling as much as us, certainly in the last couple of years here in Canada. This is arguably one of the largest drill programs in the world. We've had upwards of 26 drills on the project at any one time. Later this week, we'll get back to the 21 drills that we were at before we were shut down by the current COVID crisis. But it's allowed us to drill this deposit off in a very quick fashion. At Canadian Malartic, it took us 6 years and 1 month from the day of our first drill hole to the date of our first poured gold bar. We've been trying to beat that record. We've only been drilling now for about 4.5 years. We'll finish the resource work by the end of this year. It doesn't look like we'll beat the 6.1 years to get to, or 6 years and 1 month to get to the first big dory bar. But it won't be long after that if all things go smoothly. We also plan another bulk sample this year. We've collected 2 5,000-ton samples right now to compare to our resource. Both came off very well. I'll discuss them during the course of the presentation. And also, as we get towards the fall, we're looking forward to starting exploration on many other targets that we have on the property. We have a bank of about 150 targets property-wide. There are 3 within proximity of the deposit, one called Fox that we put about a dozen drill holes into over the last 2 years. Almost all of our drilling since 2018 has been focused on resource drilling. So we haven't gone back there yet, but it's got a footprint the same size, relative scale as Windfall. We've had similar grades. It's got the identical geology and alteration. So it's another target that we're looking forward to. And with reference to our lead speaker's comments about the Lassonde curve, many companies that go into development towards mining tend to see their share price go to sleep. But the trick to avoiding that down curve in the Lassonde graph is to have a second deposit to drill off, and that's what we're aiming to get to by this fall. One of the other aspects that's happening right now are we're looking at Hydroline Studies. Feasibility work has commenced. There's a lot of engineering going on in the background. We've been advancing an exploration ramp over the last 2.5 years. We actually have a little over 7 kilometers of underground workings in place, which will have a big effect in terms of accelerating the project. This slide shows where we stand today. This was the resource that we put out back in March. The current resource stands at about 5.2 million ounces. On the left of the screen are the main and underdog zones, a portion of which was known when we acquired the property back in 2015. There was a resource of about 1.5 million ounces of about 8 grams. We effectively had to go back and drill it all over again. The link zone on the right-hand side was all white space when we started. It was kind of a funny story there where the geologist didn't want to drill that area because he was convinced it was going off to the left-hand side of the page. And we kept going back and asking, why haven't you drilled holes? And finally they drilled a couple and didn't see anything. But then we went back and had them do it again as a series of fences, 2, 4, 6, 800 meters out. And that's when we discovered the link zone, which has turned into the central part of the deposit. It appears to be the main feeder system. But it shows you how easy it is to miss things in exploration. You really have to drill a lot to find. Certainly, our drilling is paid off in spades, and right now, and certainly for the last 2 years, we've been drilling off the basis of our own interpreted model with over 95% target success rate. This next slide shows in the green areas where the current upside potential of the deposit is. I mentioned earlier, with the 300,000 meters that we're drilling this year, the bulk of it is going to infill drilling conversion to get to that indicated number that we need for the feasibility. I expect that our 5.2 million ounces will grow closer towards 6 million ounces by the end of the year, and the grade should creep up from 8.5 closer to 9 grams on average. But what's really neat is, and what we're seeing in the current drilling and have been since January, is these zones are still expanding, both up plunge and down plunge. We're particularly interested in the up plunge areas. They're closer to surface. The entire resource is above 1,200 meters. It's all ramp accessible. We're not going to need a shaft to mine this. But it certainly looks like we're on track to add significant ounces again this year. You can see the red stars within some of those green areas where we've had significant hits, and now that infill drilling that we have ongoing this year is going to infill those areas and add them to the resource. And this is where I think we're going to get towards that 6 million ounce number, possibly higher. by the end of the year. This next slide shows a color isopac map of the grade. What's interesting to notice with links is that you see a lot of purple. This is the 10 gram plus material. And certainly what we've been seeing over the course of the last year and a half, and even more recently as we drilled down dip on links, is that it's getting higher grade and wider as we go down. This is something that's been seen in a lot of these classic high-grade long life mines in Canada. They tend to open up as you get down depth. They have a certain length and strike and depth ratio. Links as the main feeder source of our deposit as we model it is certainly living up to its expectations as we drill down dip. We're currently drilling a couple of deeper holes below where the current wireframes are. They're about 400 or 500 meters extended off where we have known mineralization currently. If we're successful in those holes, we expect those to add a tremendous number of ounces and may force us to re-examine the general scale of what we're looking at for production of the deposit. This next slide shows the gold distribution on an ounce per meter basis. We see for reference, 3,000 ounces per vertical meter is a very, very good number. And as you'll see as we get into links, and just on the link side, we have over 6,000 ounces per vertical meter. If you add in the ounces on the other side of the deposit from Underdog, that number actually goes up closer to 8,000 or 9,000 ounces per vertical meter. So what that does is it points out the ounces within a zone of the deposit in terms of how we're going to get to that production profile that we're looking for. We put out a PEA in 2018, which was predicting about 220,000 ounces a year. We'll come to that slide shortly, and I'll discuss this a bit more. But we're looking for a mine by 2023 that should be producing somewhere between 220 and 250,000 ounces a year at lowest quartile cash costs. The next slide here shows a plan map of the deposit. And again, in green on the next slide, those areas of expansion that where we currently have drill holes indicating it's there. And the ongoing drill program is in the process of fleshing out those areas and adding those ounces to our resource table. Again, this is where we're going to get closer to that 6 million ounce number by Christmas, greatly increasing the relative scale of our deposit. This next slide shows a section through links and triple links. Both of these zones are the main focus of all the drills on site right now. They're the highest grade, they're the widest, and they're wide open going to depth. Triple links, it's worth noting in the resource that we put out in March, triple links was a contributor of over 700,000 ounces, and we only discovered that last year in July. I fully expect the triple link zone to go well north of 1 million ounces as we continue to drill it up dip and down dip. Some of the deeper holes where we're looking for those 400 or 500 meter extensions of the deposit are on links 4. You can see how it follows the fault, and all we're doing is chasing it down plunge. Every time over the last 2 years that we've stepped out to drill it, we've hit the link zone, and then we backed up and did the infill drilling for the resource. And this is exactly what's happening right now. We're having that same success. On the left of this diagram, you can also see there are large parts of a mafic unit, the gabbro, that still remain to be drilled. I suspect that we may still uncover additional zones in the shallower areas of the deposit that again should add some significant ounces to Windfall. Slide 12 is a plan map looking down at the deposit. The shaded area is the main intrusive that the deposit sits around. Basically, this is a contact style mineralization. It occurs at the contacts of this large intrusive. And if you look where the words main zone are on the left and the link zone, they're basically on the nose and on the south limb of this intrusive. We haven't done a lot of drilling yet on the north contact. We do have a couple of zones called F17, F51, but there's no reason to believe that we wouldn't be able to find additional zones along that contact. I like to make a comparison of the intrusive style of mineralization. It's like taking your hand and dipping it into a bucket of water. It's going to be wet on all sides. We've only drilled off one side of that hand, and I suspect that there's mineralization on the other side. We just haven't got to it yet. Slide 13 shows the resource table. This is the one that we put out back in early March. It shows our aggregate 5.2 million ounces with the average grade of 8.5 grams. Again, I suspect that number of ounces and that grade are going to creep up towards 6 million and closer to 9 grams per ton. It's been the character of this deposit in the last 3 resources that we put out that as we convert from inferred to indicated, we've seen a grade increase. Typically, you're robbing from inferred to pay indicated when you're converting these ounces, but what we've seen is an addition in both the inferred and indicated categories and an increase in grade as we've drilled it off. This is the effect, basically, of confirming the high-grade mineralization by putting those additional infill drill holes in and allowing us to raise the grade based on a higher confidence and a higher number of samples. This next slide is an interesting one. I get the question a lot, why are we drilling so much? When we had Canadian Malartic in the first Osisko, we drilled about 1.2 million ounces to put that mine into production. If you look back at how they've been doing since we started production in 2011 and since Agnico Eagle and Yamana have been doing since they took it over, it's been plus or minus 1 or 2% from what we predicted with our original resource. High-grade deposits are no different from low-grade deposits. You have to do a lot of drilling to be sure. What this graph demonstrates is that the more we drill, the more ounces we put on the board. A really interesting number to note is that in the resource that we put out in March, we drilled about 1 million meters at that point. Based on the money we spent to that point, our cost per meter our cost per ounce discovered has been $46 Canadian, or about $35 US, which is a world-beating number. So we're defining ounces at a very cost-effective dollar amount in a very good area where we think we're going to find a lot more ounces. Certainly the drilling that we're doing will add confidence to the engineering for when we get to mining. We're not going to be expecting any surprises except to the positive sense when we go to mine this deposit. This next slide, 15, shows a deep drill hole that we completed earlier this year that we called Discovery 1. The objective of this hole was to drill under the deposit. We were looking for 2 extensions, one of the green underdog zone and another of the 888 zone, which is a zone that we discovered 2 years ago. Didn't include in the resource because it was below 1,200 meters, but we were interested in investigating it further. And then deeper down the hole, we were looking to see if we couldn't find the source of our deposit. The hole was very successful. We added 500 meters extension to underdog, which will be drilled back into resource later this year. We added about 100-meter extension to the 888 deposit. And then in the bottom half of the hole, we saw something very interesting. We had wide swaths of the drill core that averaged about a gram, half a gram per ton gold. Not economic, certainly at 2,000 meters or 2,500 meters vertical depth, but we never typically see those altered zones with high gold contents, except when we're very close to the high-grade zones like Lynx or the main zone or underdog. So I feel that while we didn't intersect a zone at depth there, we might be very close. And certainly the deeper we drill Lynx, it certainly looks like Lynx is extending down towards where we saw those alteration zones. We are planning later this year to do a wedge off this deep hole to see if we can't intersect Lynx down at about the 2,000-meter vertical level. Slide 16 shows what we're trying to put into context with things like that discovery hole. Currently, our resource goes down to 1,200 meters, and we've got a world-class scale deposit with over 5 million ounces and an average grade of 8.5 grams. If you compare that to Red Lake, Macassa, and LaRonde, all 3 of which are world-class mines, and keep in mind, none of these started as world-class mines. They were surface discoveries that then extended over 10 or 20 or 30 or 50 years and grew into world-class mines. We're dealing with a system here that I believe is going to grow into a similar scale. This is going to be another classic, long-life, high-grade Canadian mine, and it bears many of the same attributes as these very well-known mines that were one time owned by Goldcorp and currently Macassa and LaRonde are owned by Kirkland and Agnico. July of 2018, we put out a preliminary economic assessment based on the first 400,000 meters of drilling that we did. We used an assumed gold price of $1,300 and an average grade of 6.7 grams per ton, which is what our drilling was telling us at the time. Now, since then, we've certainly seen a rise in the price of gold, and our grade has grown up to about 8.5 grams. Looking at these numbers, if we were to substitute that $1,300 an ounce and the 6.7 grams per ton for $1,500 an ounce and 8.5 grams, Our after-tax IRR, internal rate of return, goes somewhere north of 100%. The net present value after tax would be between $1.5 to $2 billion. The capex stays the same at about just under 400 million Canadian. But now, because we're dealing with a higher grade, we're looking at a mine that instead of has potential to produce about 220,000 ounces a year, is more like 250 to 275,000 ounces a year. Cash cost would be below $700 US. So again, it would be lowest cost quartile. This was a very conservative PEA. We're looking at having the feasibility study out at about this time next year, based on the completion of the drilling that we'll do by the end of this year. We expect to see robust numbers. Certainly the price of gold has been working in our favor. Again, like when we did the initial feasibility study for Canadian Malartic, we were using $775 an ounce gold. By the time we finished construction and started pouring gold, the actual first price that we got for our first bar was over $1,900 an ounce. It's a bit ironic in the sense that we've ended up in a very strong gold market at the same critical time, but that'll be very beneficial for the project as you start production and you have this high gold price environment. This next slide shows results of the 2 bulk samples that we took from the underground ramp system. Again, we put in about 7.5 kilometers of underground workings right now as an exploration ramp. This will eventually double as a production ramp, and we expect it to cut about 2 years off the time to get us into production. But what it's allowed us in the meantime to do is to verify through large-scale mineable samples that are actually run through a mill, to take those numbers and compare them against what we're seeing in our wireframes from our resource drilling. The first or second bulk sample that we took in the link zone was actually close to 90% higher grade than what was predicted. In both cases in these bulk samples, what we did was we chose areas that were between 7 and 8 grams, typical of the deposit. We mined out the 5,000 tons, milled them, extracted all the gold, and then went back and looked at what the difference was. The first sample that we took from zone 27 gave us a 26% higher grade number, both with very good recoveries. Now, while it doesn't allow us to apply these numbers to our resource, we can't assume that our resource is going to be 26% higher or 90% higher. What it does tell us is that we can expect some component of higher grade when we get to mining based on how it compares to our resource. So my own feeling is that by the time we finish the feasibility, typically when you mine underground, you're looking at about a 25% to 30% dilution. That it's very possible that the higher grade that we'll see that effectively comes from the capping of the drill results will be offset by the gold that we're subtracting from that resource and that we are seeing in actual mined samples. So if anybody's modeling the deposit, I think the right number to use when you're looking at what our grade is going to be is probably the resource grade 8.5. This next slide shows the conceptual layout of a second portal. You can see the underground workings that we have in place, both the initial ramp going down into zone 27 and then links. We're looking at bringing the links ramp up to surface so it'll double the access to the deposit. This next slide shows it's a very tight layout. The mill will be sitting basically on top of links, the 2 ramps that will be delivering ore just very close nearby, and the waste pile is just behind where the main deposit is. At the beginning of March, when we put out the last resource, the Quebec government and the Cree First Nation, our property is located in Cree lands, announced what they call the Grand Alliance. This is a $4.7 billion infrastructure program over the next 30 years that will build roads, hydro lines, rail lines, and ports in the James Bay. One of the first projects that they envisioned for the first 5 years of this is a hydro line from La Belle-sur-Quévillon, the nearest town and substation, directly to the Windfall site. In effect, and we expect this will go through, we are getting a $100 million power line at effectively no cost in terms of how we would look at this in the capex of the deposit. We were initially in our $400 million Canadian capex, assuming that we would either truck the ore to La Belle-sur-Quévillon or string in a hydro line. It's about 100 kilometers away, so it's $1 million per kilometer to build the line. Now, there's no such thing as a free hydro line ever. Probably what will happen is we'll get tariff-fell, which in Quebec is about 4.3 cents, 4.5 cents a kilowatt hour. There'll be some nominal adjustment to that over the life of a 30 or 40-year mine that would end up paying for the power line. But it's a great advantage to us because as the deposit has grown to world-class scale, we'd already made the mental decision to build the mill on site. But now, certainly with the Grand Alliance making gestures that they're going to build us a power line, it's an absolute certainty that the mill will be on site with hydro delivered effectively at zero cost in terms of the capex for the company. This next slide shows the east-west road from La Belle-sur-Quévillon, where the substation is, to the site. We're considering 2 different mine locations currently. Slide 25 puts our property in context with respect to the Val-d'Or camp and the Timmins camp, both of which have produced well over 70 million ounces over the last 100 years from dozens of mines. If you took the mines out of both of those camps, they would have had about 80,000 historic drill holes. When we got to the Windfall area, just because it's a little further north and people hadn't been there doing exploration, it only had about 1,500 exploration holes. So in a relative sense, it's been very underexplored. Once we realized that Windfall was a very different type of deposit, it was intrusive related, we went out and we age dated the other intrusive related gold showings in the belt. And we found something very interesting. They're all of similar age. They all fall within about 30 million years, from 2.69 to 2.72 billion years old, which tells us that Windfall is not a singularity. This was a district mineralizing event, very much like and of similar age to the Timmins camps and the Cadillac camp. So there's no reason to believe that we shouldn't be able to find a similar number of deposits given enough time drilling and exploration. So as we bring Windfall closer to a production decision and mining, what we're going to be doing is looking for that next Windfall. We believe we found it in terms of what we call the Fox deposit. It's located 4.5 kilometers to the west. And this is the one where we have about 24 drill holes over the last 2 years. As we get towards the finishing part of defining our indicated resource for the feasibility study, we're going to start moving some of those drills over to Fox to see if we can't start our second Windfall style deposit. But outside of Fox, we have 2 other very interesting targets, both north and northwest of the deposit, northeast and northwest, with what we believe are very high potential. They're similar geological settings. We know that there are intrusives present. We haven't done a lot of work on them yet, but these are 2 other targets that we expect to start drilling on later this summer. One final note before I end the presentation, I'd like to congratulate the team at Canadian Malartic. This is our first mine. You can see they're standing around the brick, which is the 5 millionth ounce produced at Canadian Malartic. This happened just a couple of days ago. What I'd like to show you here today is the very first brick. This was the first $1 million that we poured at Canadian Malartic back in April of 2011. By the time, we also have the first millionth ounce here too. We poured a couple of these when we poured our first 1 million ounce bar back in 2013. Subsequently, and a lot of people criticized Agnico and Yamana for overpaying for Canadian Malartic when they paid their $3.9 billion. If you think about it, 5 million ounces minus 1 million is 4. Current gold price is $8 billion. They got a pretty good bargain there. They're not halfway through mining that deposit, and good on them. We certainly would have liked to have not had to sell Canadian Malartic. We're not looking to sell Windfall. We're going to build this mine and create the next better intermediate mining company. At that point, David, I'm going to end the presentation.
Thank you, John. Pithy and to the point as always. Well done. We're going to go to our panelists now for questions, and we are going to start with Stratos Manos. Stratos, do you have a question today for John?
Yes, that was a great presentation. The only question I have is, you just finished your presentation by saying you are not prepared to sell the company, let's put it this way, at this stage, but you want to build it and make it an intermediate company. In a previous case, you had a hostile bid. How are you protected this time from from this not happening again?
You're never you can never tell what's going to happen in the mining business. But when we started the first Osisko back in 2003, Sean and I were part of a private European group, and we owned over 50% of the company. As we drilled off Canadian Malartic, and then really in the spring of 2009, when we had to finance it to build, we had to raise $1 billion. We diluted ourselves down below 7%. I think we owned about 6.5% at that time. And that's really what opened the door for Goldcorp to launch its hostile bid. Now, currently, amongst the top 10 shareholders, that accounts for a little over 50% or 60% of the shareholdings of Osisko Mining today. Osisko Gold Royalties owns about 16%, and then collectively as management, we own about another 4% or 5%. So it's a different scenario today. We effectively have a blocking position right now, so you know, certainly nobody would attempt a hostile bid because they wouldn't be able to complete it. More importantly, amongst those 8 or 10 shareholders that own that 60% of the company, none of them are looking for a cheap premium to sell this deposit. We're in a situation right now globally in terms of gold development projects where there just are none. This is a premium project. It's a world-class scale deposit that will be a lowest cost quartile producer. We did a study about 5 years ago when we started the company, and we looked at everything in Canada, everything in the US, and we even looked globally. And just within North America, we only came up with 8 things that we thought we could turn into mines within 5 years. If you went globally, it was about 15. If you didn't like Africa and a few other places, it went back to about 12. Since then, probably 5 or 6 of those assets have been sold. So it shows you that in the landscape of potential projects that can be in production in the near term, there just isn't anything out there. Certainly, I think the price of gold is going to continue to increase, especially with all the printing of money that's going on right now. We're coming into the perfect storm in terms of opening a new gold mine. We own 2,700 square kilometers in an area that I personally am certain contains a lot of other mines. And, you know, really, this is a life's work cut out for the people in my company to go out and develop and start a brand new and very healthy, significant company that can add new deposits as it brings the first mine into production, and then over the course of the next 10, 15, 20 years, open up a series of mines. You know, looking back to our history and our experience with Canadian Malartic, it was really the only thing we ever had to do. You can imagine what we would have done if we'd have kept that mine in 2014 instead of having been forced to sell it. It's been producing year on year over $500 million of free cash flow. You can certainly do a lot of things with that in terms of building a company, and this time we've got a much stronger grip on it. And certainly our principal shareholders are in for the long haul to build a mine.
Okay, that's fine. And a last question: if you decide to, obviously you want to go alone on this one, would you definitely rule out having a partner? And how long do you think it's going to take in order to get feasibility study to increase the resource, get a feasibility study, then to get financing? So how long do you think it's going to take?
Yeah, well, again, the financing I think we've looked after, because all things being equal, the financing that we completed yesterday was $177 million. Assuming the warrants get exercised, it brings in approximately another $130 million. Fully diluted and all things considered in our company right now, we have access to potentially $500 million. So if we spend $100 or $150 million, call it, by the time we get to construction, arguably we have enough to build the mine. That $400 million Canadian capex was assuming that we'd have to build a power line. So if we get that power line for free, our cost is really $300. Another component is the underground workings. When we did the PEA in 2018, it was assuming that we didn't have any underground workings. And by the time we get to feasibility, we'll have inserted about $140 million of underground workings. So to build this mine, it could cost us somewhere between $200 and $300 million, and arguably we should have that in hand. In terms of timelines, I would expect the second half of 2023 to be pouring gold. We'll have the resource finished by the end of this year, first quarter next year. The feasibility out about this time next year or third quarter next year. Permitting should take 6 to 9 months, and then construction cycle is 9 to 12 months.
Thank you, Stratos. Appreciate your questions as always. We're now going to turn to Nick Polidris. Nick? question today for John?
Yeah, I just had one question. You briefly mentioned it with the 16% ownership of what? How is the shares distributed? Who owns what?
No, the 16% is held by Osisko Gold Royalties, which is another publicly traded company in Toronto and on the NYSE. Osisko Gold Royalties was the company that we founded after we were forced to sell the first company. We retained a 5% NSR royalty, then subsequently grew those first couple of royalties into a company that now has about 130 royalties. Osisko Gold Royalties itself has about $100 million of cash flow per year. And that 16% share position is held in that company. The other 4% is held by senior executives of the company and directors.
Okay, and then funds, anybody else have a sizable position?
Kirkland Lake Gold owns about 11% today. They were diluted a little bit in the last financing. Kirkland acquired their position not through a direct sale by us to them, but they acquired some positions in the market a couple years ago. They're a happy shareholder right now. There are some other large funds, both in the U.S., the U.K., and here in Canada, that own the balance of approximately 30 to 40%.
Okay, great. Excellent presentation. Thank you.
Thank you very much.
Thanks for being on the call, Nick. We're going to turn to Murray Vanderbilt. Always good to have Murray on the line.
Thank you. Clearly, most of this is about the Windfall. I'm glad you mentioned Osisko Royalties because I didn't know the tie-in. And is it Royalties that owns a piece of Barkerville? I see you only have Quivalon and Urban Berry as other properties, so you don't have any percentage of Barkerville in Osisko itself. Is that correct?
No, we don't. That's correct.
Thank you. A nice presentation. Thank you.
Thank you.
Thanks, Murray. We're going to turn to Lincoln Rothman. Lincoln.
Oh, hi. Thank you. I was wondering if you could explain a bit more of the relationship between the various Osisko companies. I know the history, but to what extent is it synergistic? To what degree do you cooperate in your activities?
Yeah, the companies all operate independently. They all have separate boards of directors. There are some crossover directors. I mean, I'm the CEO and the director of Osisko Mining, but I also sit on the board of Osisko Gold Royalties. I also sit on the board of Osisko Metals, and I sit on the board as the chairman of O3 Mining. O3 Mining was a subsidiary that we capped off into the public markets earlier. I guess last year, and we own about a 30% share position in them right now. O3 Metals is owned about 20% by Osisko Royalties, and I think that's about it. The interrelationship between the companies, if you go back to the beginning and the original founding of the original Osisko, Bob Wares, Sean Rusden, and I started that company, and we grew that into the Canadian Malartic deposit, which was then eventually sold. We stayed together as Osisko Gold Royalties. Bob split off to start Osisko Metals. I split off to restart the Osisko Mining Corporation. So each of us has gone off and done a separate role. But in terms of Osisko Gold Royalties, it's the largest shareholder in all of these companies as the company that was left over from the original company.
Well, all of these companies have had an impressive track record since their founding, but to what degree do you coordinate your strategy?
We don't. Not between the companies. I mean, Osisko Gold Royalties has its own separate strategy on royalties and other investments. Osisko Mining is strictly focused on the Windfall deposit and the Windfall belt. Osisko Metals is a base metal company. They're trying to bring the old Pine Point zinc mine into production up in the territories. And O3 Mining is focused on the Val-d'Or camp. But they each have independent strategies and, again, independent directions.
Thank you.
They're not going to get rolled up into one, if that's what you're asking.
Thank you, Lincoln. We're going to turn to Glenn Galata, please. Glenn, questions today? Can you hear us, Glenn? Perhaps you're muted. Okay, let's turn to Doug Loud, please. Doug, questions today?
Say this as a shareholder. Very happy with the presentation, but I have two quick questions. One is, for your trading in the United States, where are you traded?
That's over the counter on OBNNF. We don't have an official listing. Those happen to us as a Canadian corporation. But if you look at what we did with the Osisko Gold Royalties was once we formed that company, one of the first things we did once we became a dividend payer was we went and we listed ourselves on the NYSE. It was something that we would have eventually done with the first Osisko Mining Corporation, but we didn't have the chance to do it. We were taken out and forced to sell. Our viewpoint with the mining company is that you don't go for the real U.S. listing until you're actually in production and in cash flow. So that's certainly something that we would consider doing once we get up and producing.
Okay. And my other question was, in looking at your picture of the triple links and the gabbro, you mentioned you hadn't drilled too much of the gabbro, from my point of view, to the left of the picture. And then there's a big zone called untested. Do you not know anything about that area, or you just haven't bothered to test it yet, or you're so busy with links you don't need to?
The history of how we discovered links was, again, we had to, basically ask the guy up there 3 times to go drill it, and then send someone up there to threaten him to drill it, and then he missed it, and then I wasn't satisfied with the results, so I said, no, go drill a bunch of fences, and then we found it. And then over the course of the last 2.5 years, we've just been walking it down plunge. Especially last summer, our team, our targeting team up on site, realized that there was a whole underbelly of this gabbro that we hadn't drilled yet, and they asked for permission to drill a hole through it, and I said absolutely, and that was where they hit what looks like the dead center of the triple link zone. They hit 4 zones, and that's where we added 700,000 plus ounces in our resource this March, and again, that number I think is growing closer to 1 million by now. And we don't have any end in sight to where it goes down plunge, and we're still chasing it up plunge. So on that diagram where we show untested, it's just another area that we haven't gotten around to drilling yet, because for the most part what we've been trying to do is infill drilling to get the resource ready for feasibility. But we've had the terrible misfortune of finding new mineralization every time we back up to drill an infill hole, and then they got to go chase those down to figure out what they are. It's a Hollywood problem.
Yes. Terrible problem. Just one thing. I understand your logic behind not doing anything about trading at a higher level in the United States until you're in production. But a lot of American retail buyers can't buy your stock unless it's on, quote, an exchange like the QB, the QX or above, on the OTC above. So you may want to think about that for expanding your retail market. Yeah,
certainly, and we have, we went through this with the original Osisko Mining as well. We blue skied ourselves in every state, which allowed brokers to talk to their retail clients about it. Because until you're blue skied, they can't even do that. Certainly as the company has grown, we were $1 billion market cap a couple of days ago. Now with the closing of this financing, I think we're actually going to get up to about $1 billion US value. We're very close. So certainly we're at the scale where we'd start considering looking at a listing in the US.
Great. Thank you very much. Very interesting. Happy shareholder here.
Thank you very much.
Thank you, Doug, very much. We'll try back to Glenn Galata, perhaps.
Glenn is unmuted, but we cannot hear him.
That's okay. Scott,
he said, sorry, his mic is not working. Yeah,
that's okay.
Sorry about that, Glenn.
That's okay. Scott, questions from the audience?
Yeah, I do have a question from Richard Shue. I'm going to unmute you, Richard. Can you hear us? I'm sorry, Reinhard. Okay, Reinhard actually sent his question in as well, so I will read that for him. How much more drilling and at what cost is required to get the feasibility study, especially upgrading the inferred resource?
Yeah, certainly. We expect the drilling to be complete by the end of the year. This is part of this year's 300,000 meter program. We financed that last year with charity flow-through. So that should allow us to get to the 2.5 to 3 million ounces of indicated. So again, timeline, end of the year. additional cost is part of this year's budget. This is the approximate $100 million that we'll spend between now and feasibility, and we expect to have that resource out by Christmas or Q1 of next year.
Great, thank you. I do also have
just one further point to that, and I did bring it up earlier. You know, we are doing a lot of drilling on this deposit, but it gives us a certainty in the continuity of the deposit. And again, we've been defining ounces on the board for $35 US an ounce. That's a world-class number. So, you know, we haven't been doing excessive drilling. We've been doing well thought out, cautious, and cost-effective drilling.
Noted, thank you. I also have a question from Stephen Shipman. Stephen, can you hear us?
I can, thank you very much. And John, thanks again for your time, another good presentation.
Thanks, Stephen.
You sort of addressed a question I was going to ask about this last raise, thinking that it was going to offset the capital expenditures that you anticipate for Windfall. But it leaves a little bit of a hole that I assume, or maybe I shouldn't assume, but can I assume, is going to be bank financed. And if it is going to be bank financed, have you already begun discussions with those banks on the type of project financing?
There are a lot of parts to that question in how I could answer them. You know, arguably, I think we may actually have enough money without having to go to bank finance to build, so long as everything works the way that we expect it will at this point. That being said, if you go back to how we financed Canadian Malartic, we raised $1.05 billion in early and mid 2009 to build Canadian Malartic, and we could have financed the whole thing with equity, but we realized at the time that there was some value in having some of the government pension funds involved in the financing of the project. It certainly didn't hurt when it came to permitting. So we did about $150 million financing with the CPPIB, the Canada Pension Plan Investment Board, and some of the Quebec pension funds. We'd likely do something similar. We have been approached by some of the Quebec government funds in terms of their willingness and eagerness to be part of mine finance. But again, fully diluted right now, we have something, if all of the warrants and options and other vehicles come in, something north of $500 million. Assume that we spend about 100 or 150 million between now and start of construction, would leave us with about 350 Canadian. But the initial capex of 400 million Canadian in our PEA in 2018 assumed that we'd have to build a power line and that we had no underground workings. Those two items subtract 200 million. So, you know, we may only be looking at the need for 200 million, and we assume that we're wrong by 50%. So 300 million, we'd still have a surplus of cash.
Yep. Good point.
So unless we start playing with the relative size of production, I think we're good to go.
And the one last question, the final fully diluted, assuming everything and option, everything and warrants are converted. How many shares outstanding now after the raise?
Yeah, we issued, as of today, or 2 days ago, I guess we had 292 million shares out.
Right. Plus 48 and plus half of 48, that would be it, plus the 18. I don't think there's any more warrants left, are there? I thought they were all converted.
It's the 24 million warrants issued in the current.
Yep. Yeah, okay, 40, got it.
72, 80, 90, so 382 million.
Yeah, okay, we're on track. Okay, great. Hey, thanks again, John.
Thank you very much.
Great. I have 2 more questions so far. This one is, how is the COVID-19 impacting your operations?
And I'm showing that Osisko mug on purpose, by the way. Yeah, the COVID-19, like all businesses in Quebec, we were forced to shut down in mid-March. They allowed the mining companies to go back to work in mid-April, and we were permitted to go back to site in mid-May. It takes a day to shut the site down, and literally we send everyone home in a day except for the skeleton crew. And it's taking us a little over a month to get it back up to speed. So by the end of this week, we'll be back up to speed to where we were in mid-March. So the net effect of COVID will have cost us between 3 and 4 months of scheduled time. And that's what we're assuming right now, because it's still, you know, there may be reoccurrences. We're actually building a COVID testing lab on site. We have at any one time a rotational staff of about 250, 300 people on site. So that's between 500 and 600 people up at site, not including any visitors and things which are restricted from site right now. But it slowed us down in a real-time sense for about 4 months. We don't know what the going forward cost of time will be. But you know, there was a slight financial cost as well in terms of maintaining the staff over that 2-3 month period, and then building of the lab, but nothing of consequence in terms of our ability to finance the project.
Thank you. And the final question I have is, over the past year, there has been a notable amount of insider and management selling of shares. Would you be able to comment on that?
I don't know about over the course of the past year. So, you know, certainly over the course of the last couple of months, we had options that were issued to our employees back in 2015 when we formed the company. This is before we even had or knew what Windfall was. Those were coming up for expiry in August. I've had this question from a couple of investors saying, hey, there was a lot of selling before the financing. But not really, because I mean, you know, these were options that were expiring. These guys were put on notice last year that if they wanted to exercise them, they had to do it before this date that's coming up in about 8 weeks. So as a matter of course, they were selling their options. Outside of that, there were about 170,000 shares sold, and I think there were about 100,000 shares bought. So net selling was about 70,000 shares over the last 2 months. You know, I can't comment for other people as to why they sell shares from time to time, but you know, typically the answer is the simplest one: they need the money.
Understood. Well, that's all the questions we have from the field, David. And
Thank you. Thanks, Scott. Thanks very much. Great call. And I want to thank everyone for participating. John, I'll turn it over to you for closing remarks.
Thank you, David. Again, thanks everybody for joining on the call today. You know, we're dealing with a bit of a unicorn in the current gold market right now. Certainly, there are lots of people who are aware of what we're doing. The comments were made by our introductory speaker about a diminished number of development assets out there, and certainly everybody's scouring the world for more of them. You know, we just completed a successful what we expect to be our last financing for this company. So you know, we don't need a partner to help finance build this. We know what we're doing. We've been through larger projects before. If you look collectively at the people within the company right now, and back to the cover slide of developing another world-class gold deposit, between myself, Sean, Bob, some of the members of the Virginia team that are now part of our staff, we've discovered the last 3 world-class deposits in Quebec in the last 15 years. This is Eleanor, Canadian Malartic, and now Windfall. It's a pretty strong record. Shareholder return, and remember, this is a mining company, not a lottery ticket. So you know, you have to be patient in terms of seeing the returns. But you know, we financed about $1 billion in that first company. You know, call it $1.3 billion. And we returned $3 billion to our shareholders. It's a better record than Goldcorp or Barrick ever had, you know, corporately up to a couple of years ago at least. And this was just 3 guys that started a mining company. So, you know, we're serious about what we do. We're very confident about this deposit. We're well financed. It goes and goes. I'm pretty sure this is going to join the ranks of famous, large-scale, long-life Canadian mining companies and deposits and companies. We're due now for a re-rating. We traded about a 0.8, 0.9 times NAV multiple. Comparable companies that have deposits in different jurisdictions, which are potentially less geopolitically favorable, and are certainly less well financed, traded almost, you know, again or double that multiple. So I think we're going to see a repeat of what happened to us as the original Osisko. We financed at about $450 in early 2009, and within 9 to 12 months we were trading at about $12. You know, the market suddenly realized that we were a fully financed world-class deposit that was just going to go build. We're doing the same thing here in a roaring gold market. So I think our time is now.
Thanks, John, so much. Again, John Brzezinski, who's the president, CEO, and director of Osisko Mining. We appreciate everyone's attendance. For the, any questions that come in after the call, we'll be sure to get back to you in a timely manner. I want to wish everyone a pleasant afternoon, and thanks again for your attendance.
Thanks again, everybody. Thanks, David.